So post 75 is different, but it can still be tax advantageous. So any payments to a beneficiary are liable to the income tax at the beneficiary's marginal rates of tax. So obviously we might not know what that will be, and we don't know what if the beneficiary will be earning. We don't know their financial circumstances. The fund can be kept within the fund tax-free environment until it is needed. So then do we wait until the beneficiary is not working and is paying less income tax? What do we do? So that might be a wait and see, or it might be actually I need to get this out, and whatever rate of income tax I pay on it, so be it. Running a hotel, running a nursing home, generation of energy such as electricity and heat, any production of gas or other fuel, exporting electricity, or banking, insurance, debt, or financing services. So obviously that's going to remove a huge swathe of companies, because it's 20% or more in any of these areas, so it's certainly not the dominant bit. As soon as we're in those areas, then we're not going to be able to be within the EIS scheme. And that's just the rules that the government has created. Now, you have to hold the shares for 5 years. These are long-term investments. And we are now bigger companies. So we're back to this 250 full-time employees. Or if they are what we call knowledge intensive, or KI, we can be at 500 employees and still be within VCTs. And again, so this is when the shares are issued. And again, we're looking at this 15 million before the investment was made, and 16 million immediately after the investment. So we can't have a little the very right to these could be vulnerable to being abused. And we can't just pour money all into one company. And we're only going to be allowed up to that limit of 1 million within that particular company.